Discover Financial higher after a strong beat on the bottom line, more than $6 per share in earnings versus estimates of about $3 per share. Let's bring in Vincent Kantic, specialty finance analyst at BTIG. Vincent, this stock is a little bit of a special case because it's in the process of getting acquired, but I think important here to look through the data and get some sense of how the space overall is doing. Higher, but not for all the best reasons reflecting on the consumer. It seems like net interest income was higher because of higher loan receivables, margin expansion, loan fee income was up from higher late fees, et cetera. What does this tell us?
Great. Well, glad to be on. Yeah, to your point, loans grew 8% year over year, 1% quarter to quarter. The net interest margin climbed about 14 basis points quarter to quarter, and that's because they're charging more to their customers, so the yield is up. Losses are down, encouragingly, so down 11 basis points quarter to quarter. And delinquencies, which is a forward look, is down 14 basis points quarter to quarter. So those things about Discover are encouraging. When you look at the consumer broadly, though, Discover's network volume was down 3% year over year. And that's due to slower sales volume on the card. So the consumer is spending less on their credit card. I think that's something we've seen across the industry, and it does portend to some of the tightening that these credit cards have had and less credit availability that they're therefore giving to their customers.
So when we saw some of the bigger banks report, the ones that had more consumer exposure versus investment bank exposure seemed to be under more pressure. What sorts of questions does this raise about other companies in your coverage universe that have consumer exposure and how they might perform here?
Right. It's a fair point, and it's something consistently we've been seeing losses increasing for our customers. Many of our covered companies, many of these companies are saying that there's going to be a positive inflection by later this year, but we're really paying attention to the delinquency data to see that. It does seem like these companies have to tighten their underwriting further. So that would mean that the loan growth would slow down. That would mean that the spending capacity that these card companies are giving to their customers is going to slow down. And so we just expect a slowdown to the top line growth for any of the other credit card companies and the broader lending group for consumer finance.
Okay, so let's go back to this acquisition by Capital One of Discover. Capital One basically just saying, hey, $265 billion we're committing over 5 years in lending and philanthropy to help get this deal done. We saw it in the Discover results today. Acquisition on track to happen either the end of this year or beginning of next year. How likely is it that that does, in fact, happen and regulators don't challenge this?
Right. I think they're doing what they can in order to tilt it in their favor. So we saw that Capital One, $265 billion that they're investing in communities in order to support the deal. Discover also in its press release said that it's continuing with its merger plans and regulatory approval process. What really matters is what the Fed and OCC, the bank regulators, view this as. And we're going to get a flavor of that this Friday when the Fed board and the OCC are hosting public comments about this. Perhaps more likely the deal gets done than not. But what's really important for this deal, the things like the investments of $265 billion helped. But what the Fed has been looking at this in terms of the size of the bank that this is creating. So this is going to become a $630 billion bank, $250 billion just in credit card alone. So the largest things there, and the regulators have been less favorable about these big acquisitions. So we're going to pay attention to Friday.
All right. So Affirm's CEO and co-founder Mac Levchin was on CNBC earlier today, and one of the things he pointed out was that last quarter the company grew at 4 times the rate of e-commerce. We've seen the dynamics between the more traditional credit card companies and the buy now, pay later, or I guess I should say the lenders and the buy now, pay later companies. Can we actually say that the Affirms of the world are taking market share? And if so, is that where you would be investing and buying stock?
I think Affirm has been doing a good job, another company I cover. And as these credit cards are tightening their underwriting, as their delinquencies and losses are increasing, I think those consumers are still looking for credit from somewhere. They're still looking for their payments utilities somewhere. And when you have these other players who are able to underwrite better and provide that credit, I think they are able to take share. And those customers are fairly sticky. So when you go from a traditional credit card to another form of payment, if you serve that customer well, you are able to take that share long term, and I think Affirm is a share winner here.